episode of the M&A Mastermind Podcast. I am your host, Nick Olsen, Managing Director of Cornerstone International Alliance, a group of lower middle market firms who stretches across the globe. Here, we bring in guests who are true experts at their craft, who have a role in the M&A industry and process, and our guest today definitely fits that bill. He is a lead analyst for PitchBook, focusing on U.S. private equity. PitchBook is a tool and resource that we here at Cornerstone International Alliance use and have used for the past 5 years and find extreme value in the platform. He researches and publishes reports for PitchBook on U.S. private equity, debt, and global M&A. Today we are going to talk about what's happening in the private equity world in the United States. Please welcome my guest today, Tim Clarke with PitchBook. Tim, how you doing?
Great. Thanks, Nick, for having me.
Yeah, I appreciate you taking the time to be here with us, and it's been great getting to know you over the past couple of weeks. And like I said, we've used PitchBook for 5 years plus, and just find extreme value in the platform. For our listeners, can you just give an overview of what is PitchBook and what its use cases might be?
Yeah, sure. Well, I actually was a client of PitchBook. I worked at an investment bank doing middle market deals, and most data providers did a poor job covering private markets. So if you're an investment bank and all you do are private deals, PitchBook is the solution. It's a best of breed market data provider on private markets. 6 years ago, it got acquired by Morningstar. They're a best of breed provider of public data. So we have it all. That platform will you can spin it up for any type of data on private or public markets, and that's how I used it, and to this day.
Mm-hmm. So we're talking already, like I said, we're talking to lower middle market M&A advisory firms and advisors. Here's a cheap plug for PitchBook. Why would a firm or an advisor or analyst want to use PitchBook for the deals that we work on?
Yeah, so as I mentioned, it's an opaque area still. We've been digging out the data on private markets for 10 years. So really, to extent you're struggling, not just to find the deal data, but it's a holistic solution. If you have a business development team and they're trying to find new startups to prospect, or again, just targets for middle market deal flow. It also provides the buy side, so it provides you the contacts that are at the sponsors. It provides you the contacts that are at the corporate development teams, and most importantly, it provides you the CEOs of founder-owned businesses, which, as you know, is a big input and feedstock for middle market deals. So that's how we used it. I ran a business development team, and I also ran the research efforts, and it was the source of truth for those purposes.
Yeah, that's great to know. It's always helpful to understand what we're talking about and dealing with. And I would echo that. I've used your platform for almost 4 years now, and have used it for the same reasons. And one other area that I think, maybe PitchBook goes a little under the radar, maybe underrated in, is valuation work or estimates of value. Like, can you hit on that and why PitchBook is a good resource for evaluating companies?
Yeah, so we have various means of kind of triangulating on the prices paid for private companies. 99.5% of all deals done by private equity, for example, are not fully disclosed. You might get one input, but not all the inputs to do a simple valuation analysis, like enterprise value to EBITDA. So we've got different ways of ascertaining that information. We have these huge data teams in India and even Delaware, where they dig through articles of incorporation to dig this stuff out. And it's one of the few firms, for example, you'll see publish almost consistently, pre and post money values on VC-backed companies. So, for all those reasons, anyone who derives most of their business from private company deals has to have a tool like that to gain an understanding of how deals are priced.
Hmm. Yeah, because there's a lot of deal, I guess, revenue data out there, deal data out there that is not necessarily the highest of integrity necessarily. And so if you can have a go-to resource to figure out those values and those numbers, that's going to be hugely beneficial when you're working on opportunities for your sell side clients. So yeah, I couldn't agree with you more there. Um, so Tim, what is tell us a little bit about your role at PitchBook and what do you and your team work on?
Yeah, so in addition, I mean, the main value proposition, as I mentioned, is the data platform. We also have a news team that covers the private equity and venture capital industry every single day. And then we've got a research effort, just like big investment banks have covering public companies. We have a very robust research effort with 20 some odd analysts covering different parts of private markets. We have industry analysts who look at things like AI and food tech, and then we've got top-down analysts like myself. We're called asset class analysts. So I publish on the private equity as an asset class, and we report on all the trends. Usually, it's across um, 5 different sections. We'll look at fundraising, kind of the beginning of the life cycle. We'll look at deployment. Again, what kind of deals are struck. We'll look at exits, what happens at when things go full cycle, and we'll look at performance of that are generated by the funds. And then we'll look at valuations at the entry and at the exit as well. So we typically kind of break down our trends into those 5 sections, and the process, deliver really good insights for um, professionals in those ecosystems.
Mhm. Very interesting. Yeah, thank you. So today's topic and your area of expertise is just the landscape of U.S. based private equity firms and everything that goes involved with that. So first, let's start out. How are you defining the lower middle market and the middle market? Let's just kind of set the tone there, and everybody knows kind of what space that we're referencing when we're having this conversation.
Yeah, everyone defines it a bit differently. We define it by deal size. So deals as small as $25 million, we put into the middle market definition, and
Mhm.
deals as high as or just under $1 billion, we put into the middle market. So you typically see our research reports talk about mega deals and mega funds, and that's the multi-billion-dollar deals and funds. And
Mhm.
then everything below that is pretty much in the middle markets. Below 25 million gets, in terms of deal size, that means that might be less than a couple $1 million in EBITDA or even revenue. So we don't include that. So anything that can generate a revenue stream, a fee stream for all the intermediaries involved in deal making, we want to make sure we hit that audience, not kind of single proprietors who sell their company through their own efforts. It's really the ecosystem that services deal flow.
Okay, that's good to know. I appreciate that explanation. So, what does the current private equity market look like? I guess maybe let's look back just in the last year or two. What is the current landscape of private equity from a high level?
From a high level, we're in what you call a transition period. Uh, you know, Fundamentals have changed dramatically, or at least the playbook has changed dramatically. The private equity industry, its main stock and trade, or um, its main DNA, was the leverage buyout, and that looked like it was on pretty shaky ground a year and a half ago. No one knew we were going to enter into the steepest rate hike in 40 years, but that's what happened. And leverage that's applied to buyouts is floating rate. So every time the Federal Reserve hiked, it would transmit directly into borrowing costs. So borrowing costs went from, a 0% Fed funds rate plus, usually 500 basis points on top of that for your borrowing rates to 5.5% plus 5%. So instead of borrowing at kind of mid single digits, 5, 6%, now you're borrowing at 10, 11, 12%, depending on your credit quality. And most private companies tend to be kind of like single B at best, or, single B to B plus. So everybody's staring at borrowing costs that are double what they were. So that made a major dent in the leverage buyout. The big surprise coming out of 22 is actually we survived, even though the funding mechanism for that shut down. That's primarily for big deals, the multi-billion-dollar deals, the so-called leverage loan market backed by all these investment banks. That shut down for 8 solid months. So that should have undone the whole leverage buyout trade. But coming to the rescue was private credit funds lending directly. That had always been the staple of funding middle market deals, and they took over the kind of the jumbo loan market. And at the end of 2022, the banks have come back recently, but now they're splitting the market share. So that was, when I look back in the last 2 years, those were the two biggest changes. The LBO playbook didn't completely go out the window, but it transitioned to a different place, and you have a completely different funding source, made up of different participants.
Mhm. So yeah, what is, I mean, if you could kind of compare the old playbook to the new playbook as far as leverage buyouts go, like what changed or what are the changes or what are you seeing and how those are structured?
Yeah, I mean the mantra was buy and build. It was really, borrow, buy and build. So you would borrow your 60 to 70 cents on a dollar of deal value, and you would use that initially to buy a platform company, and then you build that platform company through subsequent acquisitions, so-called add-ons. Some of these platform companies have ripped off 100 add-ons after they're acquired by the PE. On average, they do about 5 to 10. But it was definitely that whole kind of inorganic strategy was central to the playbook, and as long as interest rates moved lower, it worked. And typically, with lower interest rates, the valuations would expand, or these multiples. So it was like a perfect. It was nirvana for PE investing for over a decade, and that's changed. So, like the playbook before was borrow, build, and buy, and now it's I would say it's unlocking EBITDA any way you can. It's finding organic growth and not buying your way into growth.
Hmm. And how are firms looking and finding that organic growth?
It's scarce. It's scarce, and even though top line growth is up, and we just printed a great GDP number, profits got squeezed when inflation was on the rise. Now inflation is moderating, but it's still hard to find. Middle markets is more insulated because they're of a smaller scale and there's room to grow. So, middle markets are still delivering, 5 to 10% top line type growth, whereas, S&P 500 basically is stalled out, not growing earnings at all recently. Um, so, um, so you find it with smaller companies. Really, it's uh, driven a, a lot of investors that typically stuck to these large deals to kind of reach down to smaller deals. We're seeing more deal mix happening in middle markets now than ever. We're on track for a record year where our definition of middle markets will probably capture 75% of all deal flow. Just for comparison purposes, usually middle markets only captures 60%. So that's a big jump. So it's dawned on everyone that they have to go smaller. They can't find the debt to finance these big deals. Um, advantage middle markets in the near term, we're seeing better deal strength. Everything is down, but we're seeing better deal strength for smaller companies.
Hmm. Yeah, that's a lot of what I've heard too within our group, and kind of that, as well as high quality companies still doing well. Maybe more the not so buttoned up type companies, distressed companies might be struggling too. Whether it's smaller, bigger deals. Would you agree with that?
Yeah, absolutely.
So what about just in general? What is, you can compare, time frames, but private equity backed companies, how has that changed over the last couple of years?
Yeah, so we pegged the universe at about just under 50%, 45% of the total universe of PE-backed companies. Again, kind of the Goldilocks, not too small, but not too big, in that 25 to $1 billion deal range. And you can haircut all that by 50% because, again, in terms of equity value, it's half that. So call it 500 million on the top end. Those constitute 45% of all PE-backed companies. We peg that number at 11,000. So roughly 5,500 PE-backed middle market companies are sitting in portfolios of U.S. PE firms at present. That doesn't include all those add-ons, by the way. We just look at the platform companies, and
Okay.
when you look at a PE's kind of company website, those are the holdings they'll show. They'll just show the platform companies because the smaller add-ons tend to kind of disappear into the folds of these platform companies. They're
Mhm.
rebranded, the executive team gets paid out, and they fold in. So you're probably talking more like 40,000 companies in terms of what
I
was
was going to
actually
ask that
acquired.
question.
Yeah, but it nets to about 10,000, 11,000, almost exactly, and half of that is middle markets.
Okay. Well, I mean, what about next year or two down the road? Is that you see that trend continuing to grow?
Well, these are platform companies, so actually the number of because of the constraints on lending, um, we've stopped growing for the time being. It used to grow, 5 or 10% a year,
Mhm.
but PEs have been less active on the platform acquisition front. So again, it's a little deceiving. There's 80% of all deals right now, all buyouts right now are add-ons, but they're not in that count.
80%. Yeah.
So you could still see a deal count going. Actually, deal count is going up perversely, even while deal value is way off. But it's all these small deals. I kind of describe it as marking time until we get a break on the interest rate front. They're just going to keep doing these add-ons, targeting companies that are accretive to EBITDA. And yeah, probably if the shadow universe of add-ons grows larger, but the platform
Hmm.
companies, they're pretty much not stuck, but they're being held for longer at present.
Hmm. Yeah. Yeah. Absolutely. Okay. That's great to know. So what about um, dry powder? I've heard that, with COVID and there's a lot of dry powder sitting out there, and is that still the case? And what does that mean for deploying that capital, that dry powder? Is that what does that impact? How does that impact the M&A industry?
Yeah, dry powder is a function of fundraising, of course,
Hmm.
and deployment, of course. So if fundraising slows, and you keep deploying at record at a record pace, your dry powder will get draw down. And that started to happen a bit last year. With the market was still buying stuff in the first half of the year, even through the summer. It wasn't until the third quarter of last year that things really slowed down.
Hmm.
So dry powder actually did deplete a bit. So we're about 10% off of the record highs, but it's still huge. It's for the USPE industry, we put it dry powder at about 800 million.
Okay.
800 billion. I'm sorry, and about half of that is middle market, 440
Mm-hmm.
billion. So there's plenty on the sidelines, but the industry has slowed its buying recently. It's less active, but advantage middle markets. It's all going toward a lot of it's going towards smaller deals.
Mm-hmm. Mm-hmm. So how does that affect, and how are you seeing private equity firms funds currently performing, and how that's played into the dry powder?
Um, yeah, fund performance has definitely slowed. I mean, 50, 60% at the peak, fourth quarter of 2021. That wasn't going to continue. We look at, I'm talking about trailing 1 year returns.
Mm-hmm.
Then it went negative for 2 to 3 quarters last year, and then it went positive again with recovery in public markets, among other things. So, but what's interesting is we drill into, again, kind of big funds versus small funds. Small funds we call middle market funds because they buy smaller companies. Your average fund owns about 20 portfolio companies. So the smaller the fund, the smaller the companies, tends to go hand in hand. Those funds have been outperforming the mega funds for a solid year. It started exactly this time a year ago, and it's
Mm-hmm.
gone 4 full quarters, and it got to a pretty wide spread of about almost 1,000 basis points, so a 10-point advantage. It's narrowed recently. It's down to a 5-point advantage. So, your average middle market fund is up 3 points through the first quarter of 2023, and your average mega fund is down 2 points, something like that. So, not huge nominal returns to write home about. Those are net returns, by the way, not gross.
Mm-hmm.
And so, again, everything is down or weak, but on a relative basis, advantage middle markets.
Mm-hmm. And so, how does that affect the cost of borrowing? Um, and what are you seeing there?
Well, it's the same cost of borrowing whether you're big or small. It's obviously less onerous to fund and finance a smaller deal. So, even like, we look at take privates, because they're so transparent. You take a public company private. Those used to be all mega billion dollar deals rather. Now 60% are below $1 billion. So even take privates, which used to be the domain of multi-billion-dollar deals, are going small. And it's because of the constraints on leverage. I mentioned in the old playbook, you know, you'd grab 60 cents of deal value in debt. Well, now that number is like 40 cents, just over 40 cents on average. It's a huge drop from even last year. It's never been lower, actually. Now, that's based on a small sample size, the ones that kind of get funded by that big leverage loan market, but still, you can't expect to get 50 cents plus on your dollar from debt markets, from lenders. And primarily that's because interest rates are high. They're just not going to lend you so much that you're going to choke on it and put their interest payments at the risk further down the road. So everything is smaller. So if you write a smaller check, to write a smaller check size and to still have an attractive leverage ratio, it all adds up to doing smaller deals. And even these carve outs, for example, those are smaller deals. If you can't buy a company in whole, then you carve out a piece of a company in parts. So that's another deal strategy that's working, and that falls into our definition of middle markets as well.
Mm-hmm. Yeah, very interesting. Very interesting. What about deal types? What are some new deal types that you're seeing that are favoring the middle market, lower middle market?
Yeah, so I mentioned divestitures, carve outs. You know, those were kind of like really out of favor a year or two ago. Now they're 10% of deal count across the entire market. I drilled into that lower middle market before this call. They're almost 20% of all deal count in the lower middle market space. Again, deals like we define deals below $100 million as lower middle market.
Mm-hmm.
Add-ons, virtually all of your add-ons are going to be below $100 million in size. You're gonna tack them onto a platform company that you bought for 100 million plus, maybe 500 million, and yeah, your add-on can't be bigger than the mothership. So a lot of those are smaller slices. And growth equity is a PE deal type, and growth equity is where you're not taking a control stake, you're taking a minority stake, but it's a big minority stake. It still gives you a lot of influence. It's
Mm-hmm.
either a single PE or a small club of PE, and it tends to target faster growing companies, and it also doesn't rely on debt. Those are equity only deals. So those are three examples of deal types that we've seen really trend up in the last 4 to 8 quarters.
Mm-hmm. With that being said, I guess what advice would you give advisors? Do they need to leverage those deal types? Do they need to be cognizant of it? Is that something, strategy they should use when they're creating these deal structures, these opportunities that when looking for a private equity buyer, and they got to be mindful of that, right? So what would your advice be to those advisors when they're looking at structuring their deals?
Yeah, well, as I mentioned, I used to work in an advisor before this job, and we never gave a second thought to whether the sponsor um, had the financing, right?
Mm-hmm.
It was almost like an ATM machine. You would just plug into it, right? We just kind of took it for granted. But now you have to. I mean, first of all, you don't want to waste a lot of time prospecting companies that are, uh, that have too much leverage, and are burning cash after interest. And you know, they're kind of in a feeble state by the time you remove that leverage, and you're going to replace it with even higher cost leverage. So I would get to the data behind these companies. Look at if you're prospecting companies that you suspect have any leverage. Unfortunately, now you have to look on the other side of the capital structure. You got to look at if they're over leveraged, if they're burning if they're burning cash in the process to make their interest payments, and you can't take it for granted that you'll be able to line up the financing on the other side. So the best target is one that's in a net positive cash position, both operationally and its balance sheet. It's not leveraged, and you take it over, and if it hasn't been there hasn't been a good value creation plan, you put one in place. And a lot of it goes back to basics. You're always prospecting the founder-owned businesses to begin with. Those have actually upticked to, by our estimate, 60% of deal flow involve family or founder-owned businesses as sellers.
Mm-hmm.
And so that has become an even more important source of finding exiters, because the PEs certainly aren't selling, and so you're kind of down to, okay, what big company wants to divest an asset, and that's hard to find, but that's definitely a trend that's happening, and finding the family-owned businesses that have that type of profile, that are motivated to sell, and you're usually representing them, so you want a good story to tell, and make sure it's growthy. It's got that organic growth. That organic EBITDA growth is certainly at a premium at present. Every sponsor is looking for it, and every corporate, for that matter, is looking for it.
Mm-hmm. Organic growth, yeah, that is definitely good advice, for sure, and something to be on the lookout as you're looking for prospects and bringing good companies to market. And we look at you want to do your due diligence on the front end to make sure that you are bringing deals that are quality, that are going to be successful in the exit process. That we want to make sure that we're being successful for our clients. So to have those options, those different kind of tools in the toolbox, so to speak, extra ones that can help us determine that and then help best advise our clients would be extremely helpful. So, Tim, I really appreciate the insights on that. Now, let's shift. Take out your crystal ball for a minute. What does 2024 look like? Not one for private equity, but two from a deal flow perspective, as we're looking on, bringing on new clients and still getting deals closed and things like that. So, what are you seeing as far as next
Y-
year or two goes?
Yeah, I mean, it's we're in a we're entering the second year of the downturn. I kind of look more broadly at the M&A market, right? And then the M&A market takes its cue from the equity and debt financing markets. So it looked like the IPO window was cracking open. Now it's closed because you don't want to bring a company to market when the SEC could shut down with the government on November 15th. But hopefully we'll get that behind us. And yeah, I think the recovery got pushed by at least a quarter. Um, you know, among all these other things I just mentioned, you've got the geopolitical risk that went up in the last month. So
Hmm.
so the third quarter actually was an air pocket, um, but everyone went to the sidelines as 10-year rates went up and geopolitical risks went up, and
Hmm.
government might shut down, might not. So those have to diminish going into next year. I think they will, and then yeah, you'll slowly restart the engine. Um, the debt markets actually are open. That leverage loan market I mentioned at the outset, that's reopened. It's not gangbusters, but it's decent. So that's come back to life, and then you've got this new source of funding, private credit funds. So the debt is there. A lot of money has been raised on the debt side. You just need a catalyst. So the catalyst is people get some line of sight on lower interest rates, maybe as we close out the first quarter. The market's a discounting machine that gets the equity, uh, IPO market reopened. That's just important for psychology. The M&A market takes its cue from the IPO market lots of times, so that reopens, and you get this thing going into the second quarter of the year, and then the back half is when you'll see the deal volume, and you'll have a distressed subset of that deal volume. You'll have a distressed wave
Hmm.
of M&A. Not all these companies are going to make it to the finish line. They're going to run out of debt. Companies can only borrow this M&A money for 5 to 7 years, and they're coming up against a maturity wall. So you'll see some haircuts and valuations, but I think I think it's a muddle through scenario. This is a really difficult transition. It's amazing that we didn't shut down when the leverage market shut down in 2022. So I think PE industry has been very resilient. It's made a lot of innovations. They're the ones who kind of raised money for these private credit funds to kind of solve their own problems. So I could just see a muddle through scenario. I see volumes recovering in the second half of next year,
Hmm.
um, maybe as early as the end of the first quarter. But we definitely got pushed out with the geopolitical events of the last 30 days, really.
Hmm. Yeah. Well, that seems like somewhat of a positive outlook. I think we always got to be positive, right? But being
Yeah,
realistic at the same degree. So, I mean,
yeah,
you brought up some good points, there, and I think something for all of us to consider and weigh in on and kind of fight through. I love the metaphor of muddle through. I think
yeah,
that's a great that's a
yeah.
great metaphor
But that's a
for
big
us.
top-down view. That's a bird's eye. Like it's like real estate, location. It's in our market too. It's okay. Where are you? Big cap, you small cap. Middle markets is still relative is more healthy relative to the larger market. So companies
Mm-hmm.
are going to trade these founder-owned businesses that has nothing to do. Well, it has something to do, but their motivations are different. Not the least of which is age and demographics. So
Mm-hmm.
middle markets right now is more friendly than the mega deal.
Mm-hmm.
Being a banker on the mega deal, I think
Mm-hmm.
is very tough right now, but it's better in middle markets.
Yeah. And like you said before, especially with private equity and the platform companies, not necessarily growing, but it's the add-ons, and I think that fits really into the type of clientele that we're working with are those founder-owned, sub $100 million companies. I think that that poses positive for our group and our listeners here.
The other thing I didn't mention, the other thing I take comfort in is it's a very simple relationship. We just basically look at the multiple struck uh, in the M&A market versus how public companies are trading in the public market. It's not a perfect comparison because
Mm-hmm.
our companies aren't quoted every day. But you just look at it historically, and that is back to a very wide spread. Private markets, because most M&A are involve private companies,
Right.
are at a record, almost at a record spread again versus public markets. I look at EV to revenue. You're like 3.5 times on public markets, S&P 500, and you're like 1.6 times for M&A.
Mm-hmm.
That's puts you right back to where you were in 2020 when all the craziness happened, all the SPACs and the IPOs. So eventually, that arbitrage, closes, and it's either companies going from private to public or public companies buying private companies. But I would, there's too much pressure building on that, and I would expect that to be converged in a positive way for our markets.
Mm-hmm. Yeah. Wow, that's a lot of a lot of great insight, Tim. I know you and your team work very hard on, researching the data, compiling these reports, sharing the reports, and I really appreciate your time today, sharing all your knowledge and all you and your team's work with us. And undoubtedly know that this will definitely have some moments when our listeners view this episode because just a great way to look at it, and especially when it comes to private equity. And we do a fair amount of deals with private equity firms as our buyers on the other side of the table. So definitely great intel, great explanation, and really appreciate you joining us today, Tim. Where can everybody find you or PitchBook or more information and how to connect with you guys?
Yeah, pitchbook.com. Maybe you have to fill out a little form, but you can get our reports. We're the only firm that I'm aware of that publishes on U.S. Private equity middle markets. Yeah, so
Mhm.
we have a quarterly piece, so you can grab that on a complimentary basis. But pitchbook.com is where it all happens.
All right. Tim, thank you very much for joining us today. Tim, lead analyst for PitchBook, focuses on the U.S. private equity market. So, Tim, thank you again. That wraps up another episode of the M&A Mastermind Podcast. Please like, share, and comment this episode. That would help Tim and myself out tremendously. And you can find all of our episodes at cornerstoneia.com/podcast. Thank you for joining us today. Until next time, take care.